The claim of right doctrine, it basically says this. You are taxed on all income asserted, and that's an important word. You are taxed on all income asserted to be yours in the year when you took unrestricted control of it. Let me say that again. You are taxed on all income asserted to be yours in the year when you took unrestricted control of it. Okay. Now, if we were talking about a cash basis taxpayer, this would sound familiar if you've seen the other discussions of doctrines. With a cash basis taxpayer, it says that it's income to you when you actually receive it or when you constructively receive it. It becomes a lot more complex if there's an accrual-based taxpayer. And a lot of times with an accrual tax basis taxpayer, most of the transactions might be pretty straightforward, but some of them may not be. But with an accrual-based taxpayer, we're saying that the taxpayer must reasonably expect the receipt in the current year. I know when we were talking about doctrines we talked about cash basis accounting and accrual accounting when we talked about accounting doctrines. And, we said that if you're an accrual basis taxpayer, you record the asset when you earn it, and you recognize the income when you earn it, even though you may not have received it. You recognize the expense when you incurred it, and you may not have yet paid it if you're an accrual basis taxpayer. Now, so the claim of right, if you reasonably, it's asserted that it is yours and when you took unrestricted control. Now, an interesting thing to note here, which hopefully you don't ever have to be involved in, but this actually applies whether the income was lawful or unlawful. So if you're out selling drugs and doing other things, it's unlawful income, but you still got to pay tax on it. And the claim of receipt doctrine is important. When we were talking about issues associated with the claim of right for cash basis or accrual basis, I made the point that it was whether it's lawful or unlawful, it's income. And we also, if you have, and let me read it to you, if you acknowledge an obligation to return or repay the money when the time you received it, but you acknowledge an obligation or a need to return it or repay it, you don't have to pay it at that time. You don't have to pay tax on it. Probably the best and easiest example is a retainer. There are a lot of services that if you're in business, you collect a retainer. Now, sometimes if you get a retainer and you do work for people, rather than them pay the bill, you apply it to the retainer. Now, in our business at Kern & Company, when we're doing business valuations or we're doing forensic work, our engagement letter says that the retainer the retainer will be applied to the final invoice for the project. Okay? So, and the reason we do that is that when you're doing valuation work, they may not like the number you come up with. Or if it's forensic work and the side you're with, helping, doesn't win the trial, okay, they may not want to pay you, whether you've earned it or not. So you need to, so what we do, our engagement letter says it'll be applied to the final invoice for the project. Now, if we get to that point where the project is over and they owe us, say, we've sent them an invoice for, say, $1,000, and we have a retainer of $5,000, we'll have to send them a check for $4,000. Okay. So it's the point is that you've received money, and if you have acknowledged, which our engagement letter does, if you have acknowledged an obligation to return or repay it, and you acknowledge that when they sign the engagement letter, that is not going to be income because you don't have a claim of right at that point. Another area of income that falls under this claim of right doctrine is what is called excessive income. Now, I'll tell you, you don't see this very often. I think in my entire career, which is 40 years or more, I think I've maybe seen it 3 times. And I saw it quite recently, as a matter of fact, again. But the IRS can look at the income that you got and say that it was excessive. Now, they're only going to do that if they think there was something perhaps shady going on, or sometimes they seem to do it just because they think they can generate some tax dollars. But I've seen this happen. And what happens is that, let's say you got this income 2 or 3 years ago, and now the IRS is coming in doing an audit, and they're saying it was excessive. And you actually have to pay some of it back and give it back. Now, you get the deduction when you paid it back. So you paid income tax on this excessive income when you received it. Now you're going to get a deduction when you pay it back. And where you can lose out is if the tax brackets are different at the 2 different times. You could end up actually having to maybe, if you're getting the tax write-off when you pay it back, and you're in a lower bracket than when you paid the tax on the excessive amount, you can lose some dollars that way. Excuse me. We did talk about the retainer in the way that we handle it here at Kern & Company. But even if you're just a general contractor that gets retainers, suppose, this is an example, suppose you got a retainer, you decided you're a construction guy. You got a retainer, you decided the construction was complete. Maybe other people thought it was complete as well, like the customer. And so you took the retainer has been sitting in an escrow account. You take the money out of the escrow account and you put it into your regular business checking account. Now, let's say that a year from now, or 2 years from now, there's a problem on the job. The customer's unhappy. So maybe you go to arbitration and you have to refund some of the money. Now, when you took it and out of the escrow and put it into your own account, you and maybe even the client and everybody, the customer, was happy, thought you had earned it. But later it's decided that something wasn't right, so you have to give it back, and then you deduct it in the year that you paid it back. So again, there can be a tax rate difference. And so that's about it on as far as this doctrine is concerned. It's when do you have the right to claim the money? That's when it's going to be taxed. But there can be some complications. Thank you.